Well, good afternoon and welcome to HYROX's weekly webinar where we are going to talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for your and our investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I am joined by my partner and colleague, Paul Tepsich, the founder of HYROX, who does some really great bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a listener for the first time and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do each week, let's quickly recap our themes for 2016, and obviously the one that has been the overriding theme for this year is that financial markets will remain volatile. While January and February saw a spike in volatility, but markets then settled thanks to continued central bank monetary stimulus. But now volatility is spiking again as uncertainty levels are rising on a global scale, with the UK referendum showing that a majority of voters wish to leave the European Union. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. Now, the heightened level of uncertainty hanging over the global economy at the moment has increased the chances of a global recession, and that could well be a catalyst that drags the U.S. economy down with it. Low inflation and deflationary pressures will likely continue until economic growth can return, as stimulative central bank monetary policy on its own has not succeeded in reigniting global economic growth. Geopolitical uncertainty is something that we've been talking about more recently, and it's taken center stage. The fallout from the Brexit referendum and the rise of populism in developed nations, and especially in the United States, will hang over economic decision-making in the future. There has been a flight of capital out of riskier assets, and the bond market has been a leading indicator of this as uncertainty grew. The equity markets prices have fallen significantly, but they still remain expensive as investors consider the future of corporate earnings and valuations. Price discovery will continue until a reasonable equilibrium is determined, but there is no clear economic direction at this particular point in time, and with no clear economic direction, businesses will likely postpone investment decisions and consumers will postpone spending decisions until they can get a sense of comfort in the future. Now, this does not make for an environment of solid investing returns. However, there may well be a time in the future when more reasonable values will offer good investing opportunity, and we should and will be priced, should be and will be prepared to take advantage of these. Let's look at what has been driving the markets over the last week. Needless to say, and as we had projected, volatility did spike back to January and February levels and has moved back above its long-term averages. Now, fear spiked lower, but has rebounded. The market has rebounded a little back into neutral territory. The best buying opportunities present themselves when fear is running high, and we are prepared and patient to wait for those opportunities as they come to us. Well, since our last webinar, our benchmark World Equity Index is off by about 5.5% and is now down about 3.25% on the year. The Shanghai Composite Index was the best performer since last Tuesday. The Euro Stoxx 50 index was the worst performer. The TSX has been the best performing country index in the developed world this year. The Japanese Nikkei 225 has been the worst performing index. The longer-term downtrend continues for our benchmark all-country world index, with the next test of buying support likely to be about 15% lower near the 45 level. The volume spiked following the Brexit decision with a 5% sell-off. The one-year total return has been a negative 8.43%. The three-year annualized total return, 5.14% growth rate, and the five-year return about a 5.3% growth rate. And if you combine the equity and bond indices into a balanced scenario, the one-year total return has been about a negative 2.7% for the 60% equity, 40% bond index combination. It has been positive 5.18% over 3 years and just a little over 5% for 5 years. For a less risk-oriented 40% equity, 60% bond combination, the one-year total return has been close to flat. For 3 years, it's been about 5.21 and just a little under 5% for 5 years. When you are comparing the return on your portfolio, don't forget to include your fees and MER costs in your calculations. Well, the flight to quality over the past week has driven the U.S. government bond index significantly higher, and as a result, U.S. and Canada 10-year bond yields are close to their all-time lows. We are not likely to see mortgage rates rising in this environment. And not surprisingly, gold was up and oil was down. The Bloomberg Commodity Index continues its new uptrend, but is off of its recent highs. The Broad and Diversified Benchmark Equity Index, upon which we gauge the performance of our model and portfolio performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. With over 50% of the companies in our benchmark domiciled in the U.S., we keep a close eye on what is happening there. Well, first to the political stage, where we find Clinton further building her lead over Trump. However, there is lots of time between now and next November. Well, 2 weeks ago at their meeting, the Federal Open Market Committee members indicated their expectations for future interest rate increases had further scaled them back. March's dot plot on the left last week, or the June dot plot on the right, with the increased levels of global uncertainty and volatility. This may keep them on hold even longer. It is our belief here at High Rock that an increase in interest rates in any manner will flatten the yield curve and potentially fuel the next U.S. recession. Now, when faced with increased levels of uncertainty, the first thing that businesses do to protect themselves is to cut costs. The fastest and easiest way to do that is to decrease the costs of employment by letting workers go. That is why unemployment rate jumped prior to a recession beginning. Today, Dow Chemical announced layoffs of 2,500 employees. Now, we're going to watch to see if this becomes a pattern, because it may be somewhat important as we look to the future. For the second quarter, GDP expectations are lower at 2.6% this week, with a decline expected in residential investment growth moving forward. Now, elsewhere in the global economy, and as we are all aware, a majority of UK voters voted to leave the European Union. Now, since this was decided late last week, there has been an enormous amount of commentary written and discussed in the media. There are a wide number of opinions about what will happen next, but what we do know is that it creates huge levels of uncertainty. Brexit heightens the risk that other countries like France, Italy, and the Netherlands may look to leave the European Union through votes of their own. France's far-right National Front Party is already calling for a referendum. A primary long-term concern is that the European Union experiment fails and those members that have struggled within the framework decide to exit the Union. Markets will increasingly speculate that the troubled periphery countries such as Portugal, Italy, Ireland, Greece, and Spain may attempt to exit the Union, and this could bring about the end of the common euro currency. As was expected, if such a result occurred, the British pound basically fell off of a cliff to record lows, down over 10% at the moment. Now, the Standard & Poor's rating agency lowered the rating on UK government debt to AA from AAA based on a projection of economic growth, which lowered GDP to 1.1% from 2.1%. Both the government and opposition in the UK Parliament are in tatters. Prime Minister Cameron resigned on Friday, and Labour leader Jeremy Corbyn lost a no-confidence vote by his own party today. Now, the European Union is playing hardball with the UK. German Chancellor Merkel has said that the EU or the UK will not be able to do any cherry picking of the better parts of the agreement with the European Union, and European Commission President Jean-Claude Juncker said there would be no negotiations without the notification that the UK was actually leaving the European Union. Global economic growth estimates are being revised lower across the board, and global bank shares had their worst two-day fall on record. Okay, so where's this all going to take us? Well, let's see what the bond markets are suggesting. In light of the Brexit vote, the UK yield curve flattened significantly, which is indicative of a greater likelihood of recession in the UK. And two-year yields, and lower two-year yields have anticipated Bank of England intervention and the possibility of an interest rate cut. Both the U.S. and Canadian yield curves followed suit, while German yields moved lower, closer to zero past 15-year maturities, and almost all of the Japanese yield curve has now fallen below that zero level. Truly uncharted waters and not a symbol of confidence for the global economy going forward. And as we monitor the potential for a U.S. recession, long-dated yields fell more than shorter-dated yields as the U.S. government bond yield curve continued to flatten. And as we have stated previously, prior to a recession, historically, a yield curve will flatten as it did in 2007 and in 2000. And this process has already begun for the next flattening of the U.S. yield curve. As for equity market value, when investors buy stocks, they buy a stream of future earnings. Price-to-earnings ratio represents a metric to measure stock prices relative to those earnings. The 10-year average price-to-earnings ratio is 14.3 times. The 12-month forward price-to-earnings ratio currently now at about an expensive 16 times, down from 16.4 last week at this time and 17.1 when the equity market was at its highs over a year ago. Well, not only are prices expensive relative to earnings, but there have been 4 consecutive quarters of negative earnings growth, and expectations show that the second quarter will be the 5th, with expectations showing negative growth of about 5.2%, and earnings growth for all of 2016 still expected to be less than 1% growth. So it's hard to expect growth in equity markets when companies are not growing their earnings, and certainly the shock of the Brexit vote is going to likely impair earnings growth even more. We'll just wait to see what some of those expectations are revised to going forward. What does it all mean? Well, for over a year now, we have taken a cautious and defensive posture to investing, and it has been fortuitous for our clients and for ourselves. Now remember that we invest in the exact same models and securities as you do. We remain defensive because we see few, if any, good buying opportunities at the moment. We monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain cautious. With increased levels of uncertainty arising from the Brexit referendum, we are in no hurry to take added risk unless we see a reasonable opportunity. Cash and cash equivalents have been and continue to be important defensive assets, so we are still carrying greater than normal cash balances in our models. Please remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. Rebalancing on a regular basis is crucial, and this is something that we meet on each week. We will be doing that again tomorrow after all of the movements that we've seen over the course of this week. We know that different asset classes will outperform or underperform at different times, so we've seen some definite underperformance over the last week, and that may indicate some potential for opportunities. But again, we want to be certain that when we do buy, we're making the best possible analysis of that opportunity. Our goal is to get the best risk-adjusted returns that are as possible for ourselves and our clients. A while back, Paul made some top picks on the BNN's market call. One of those picks was to own 30-year Government of Canada bonds. The 30-year Government of Canada prices spiked over the course of the last few days as equity markets dropped, providing a very good offset to those equity positions that we are carrying and helping to reduce volatility in our portfolios. Paul, I don't know if you have any comments that you want to make, but please join us and feel free.
Not much to add, Scott. Just monitoring a few positions, doing a little bit of picking away, working on one in particular, which is a mergers and acquisition, a takeover candidate. So continuing to do some work and looking at a few new positions and trying to add some value here and there where we can.
All right, thank you. And as we do each week, let's have a look and see what sort of data is coming to us next week. Starting tomorrow, we're going to get some of the Euro area June business and consumer confidence numbers. Now these will be pre-Brexit, so they may have a little bit less bearing than they might otherwise have had. In the U.S., we're going to see May consumer spending and the Fed's key inflation index, which is the core PCE price index. So we'll see that for May as well. In Japan, we will also see industrial production numbers from May. Thursday, we're going to see the latest information on Euro area inflation, that data from June. We will see some pretty long-standing or delayed results from Canada's April GDP. We'll see May inflation for Japan, and we'll get a glimpse at what's going on in China as far as manufacturing is concerned. On Friday, we're going to see Euro area manufacturing for June and the May unemployment data, as well as some June manufacturing indices for the U.S. Of course, Canada, it is our national Canada Day holiday. On Monday, it is the U.S. Independence Day holiday. And then on Tuesday, we're going to see May retail sales. And of course, we'll be back here as scheduled, regular scheduled High Rock webinar. Okay, that is it for today's discussion. If anyone who is listening might have a question, please feel free to jump in and ask. Paul, do we have any email questions?
I actually have a question from a client of ours I had a meeting with this morning, and maybe you could explain to our listeners and viewers. But his question was pretty simple. Over the past 2 or 3 days on this downdraft with the market weakness, have we done any buying? Because we are sitting on pretty defensive cash positions. So I'll let you answer that.
Yes. So in our global equity model, where we've been running very high cash balances, we did pick away a little bit when the first down spike came on Friday morning. We picked away a little bit at our international equity ETF that we buy. It really covers all of non-North American countries. So it is a very broad and diversified index, but it came down fairly hard and fast, and we thought, well, let's see if we can add a little bit of value in there. Then it slipped a little bit yesterday and came back to just a bit above where we bought it over the course of today. So again, we've been very light in our holdings. We still are somewhat reticent to own U.S. equities in any big way because we think they're extremely expensive. And we think, of course, that there is potentially greater downside for the U.S. economy coming. So we're being a little bit cautious there. You know, we're really thinking long-term here. Often you will get these short-term moves where you get a big down move, you get a little bit of a short-term buying, and you watch as we did today to see markets jump back up. It's natural knee-jerk reaction. It is a symptom of higher levels of volatility, as we've talked about. We want to be careful that we don't get in here too early, especially in some of the things that are still relatively expensive. So not like we're not watching this evolve, but we think there's so much uncertainty now, probably one of the greatest amounts of uncertainty that we've experienced outside of that 2008 Lehman Brothers debacle. But there is still so much left out there that we're just not really aware of that could possibly happen, and you know, the domino effect in Europe being one of those things, how it all impacts other developed nation economies and things like that, and very much so how all of this is going to impact the U.S. You know, if the U.S. consumer decides that they're not comfortable with the current situation, then that's one thing. But if U.S. businesses are uncertain, they will pull back on investing, and I think that is something that could be very impactful in a negative way on the U.S. economy going forward. So again, we're going to be cautious, but I know you've been looking at a few things, Paul. So in the tactical model, have you been adding anything?
Yeah, we did. We added into one stock a position that we already had. We just actually we probably well, we added about a 30% more weight to it, and I'm tempted on a few others. But you know, just one other thing I would add, Scott, is if you look at some of these European stock markets, they're really, I mean, I know they gapped down Friday morning, but they're really only back to kind of where they were 2 weeks ago, pre the Brexit news, and really they just ramped up because nobody thought Brexit was going to happen. So I think our clients and viewers should know that we don't think there's enormous value here. Like I think we're looking for a much bigger drop according to our valuation research. So you know, we're just back to where we were 2 weeks ago. To me, no big deal. But I think there's an enormous amount of risk through the uncertainty and the length of that could last, the length of time. So we will continue to be defensive.
Yeah, and that's something you and I both agree on. So that I think is pretty clear. All right. Well, I think we've taken up everybody's valuable time enough with our discussion today. So if anybody does have questions and wants to email us, we are, of course, more than happy for you to send that on. Also, any feedback on our webinar, anything that you want us to cover that we may not be covering on these calls, always appreciative of that kind of feedback. But thanks so much for taking the time to tune in. Have a great rest of the week and a happy Canada Day weekend. Don't forget to tune in next Tuesday. But until then, this is Scott Tomlinson signing off.